All right, we'll start our webinar now. So today we will have Singapore Banking Monthly, China Weekly, Singapore Strategy, and our technical outlook. So first we will move on to Singapore Banking Monthly. So this is the monthly update for the Singapore banking statistics. So for our loans, April loans slowed further to 1.4% year on year, and March was 2.2%. So from the graph here, you can see the light blue lines are overall Singapore loans growth, and the red line is our consumer loans, and the dark blue line is our business loans. So overall loans was mainly held up by our business loans. So for business loans wise, it was the building and construction sector that continues to prop up the growth. So the building and construction sector loans grew 2.3% year on year. And for them, they made up 34% of the total business loans. So this sector is still growing because of the drawdowns of loans from existing projects in the pipeline. And for the red line that we have been seeing, which is the consumer loans that has been decreasing and contracting for the past few quarters, it's mainly because of persistent weakness in our housing loans growth. And this is mainly due to our property cooling measures as well as high interest rates. So to put things into color, housing loans made up 30% of total loans. And our worry is that the continuous contraction in our housing loans growth may limit the upside in net interest margin expansion amongst the banks due to competition for mortgage loans. And for the deposit statistics, we can see that over here, the red line is the fixed deposits growth. It has been surging for the past 1 year, whereas our CASA, which is our current account and savings accounts deposits, has been contracting for the past half a year. So for CASA deposit, it contracted 1.1% year on year this month, which is the slowest in 3 years. And fixed deposit continues to surge 21.6% year on year. So in a higher interest rate environment, we usually see a higher proportion of fixed deposits in the mix. So this will be a challenge for the banks because as the proportion of fixed Ds increase and CASA decrease, the cost of fund increases as well. So it makes it a challenge for the banks to achieve net interest margin expansion in such an environment. However, we expect competition for fixed deposits to taper off in the second half of this year and funding pressure to ease since no more rate hikes is expected in 2019 and there might be further rate cuts expected as well. So for the interest rate statistics, May's 3-month SIBOR grew 6 bips above last month's 1.946, and then 3-month SOL also broke above the 2% level and it rose 8 bips to 2.05. So we believe the pause in interest rate hikes and potential cut in interest rate limits the upside for net interest margin expansion. And as we reach the end of the interest rate cycle, 2Q19's banking results may also be the last net interest margin rally for the year. We still expect the banks to deliver full-year net interest margin improvement for FY19 as compared to FY18 due to the lag effect of loan repricing. So interest rate hikes from last year has yet to fully pass through into the bank's books. So this lag effect will continue to provide your net interest margin improvement, however at a lower magnitude of 4 basis points in FY19. So last year, FY18 full year's net interest margin was around 8 to 11 basis points expansion. So for SGX, this is the data chart for your SDAV as compared to your DDAV. So SGX derivatives business doubled around in 5 years and should support earnings when its security business is slowing. So SGX derivatives business is directly more or less correlated to volatility in the market. So on this second chart here, you can see that SGX DDAV versus the VIX index, it moves roughly in line with the VIX index as volatility increases and decreases in the market. So with the resurgence of the trade war and trade tensions, there might be a higher increase in volatility expected in May's data as well. So we will see what happens when SGX releases the May statistics. So for the Singapore banking sector, back to Singapore banking sector, we maintain it as overweight. So because we believe that while the trade war affects investor sentiments in the near term, we believe that the bank's healthy and robust fundamentals remains intact to withstand risk and deliver growth on a sustained basis. So the operating environment still remains stable despite slowing regional growth. Asset quality remains benign. However, SME portfolio may face some stress from slowing trade flows as well as the higher interest rates. So the banks are keeping the SME portfolio on a tight leash right now. And for the banks, they have been increasingly diversifying their revenue streams into more stable areas such as fee income, net interest income. So the fee income is areas such as loan fees, credit card fees, wealth management, etc. So they want to increase into more stable fee and recurring fee to reduce the proportion of earnings from volatile revenue streams, such as the trading income and investment gains. The banks are also implementing a lot of digitalization efforts and better cost management to improve their CIR ratios, and also low provision should also provide upsides to our ROEs. And the banking sector overall still provides attractive dividend yield of around 5%. So there's potential risk in our call to our overweight recommendation. So any miss in cost to income ratio or limited rise in interest rates or rate cuts and rising competition may result in lower than expected net interest margins this year. And volatility in the market due to the trade war may lead to higher capital market link revenue losses. And changes in market link assumptions resulting in higher expected credit loss, which we saw last quarter, and deterioration in SME portfolio quality if the overall trade continues to decelerate and interest rates increase. So for our top pick, UOB remains our top pick because of its exposure to trade war effect being relatively muted as compared to DBS and OCBC. So from this chart here, you can see that in terms of profit before tax, UOB has the lowest proportion of profit before tax arising from Hong Kong and Greater China at 10%. So the highest is DBS, followed by OCBC. So for DBS, it's because they have the Tao Heng Bank, more or less because of Tao Heng Bank, and then OCBC, they have the Wing Hang Bank in Hong Kong. So having lesser exposure to Hong Kong is why we prefer UOB, and this is the Hong Kong data. So as you can see, Hong Kong's loan growth is decelerating for the past 1 year. And for HIBOR, it fluctuates quite heavily. And right now, they recovered slightly since the plunge in March. So Hong Kong's loan market derives almost majorly from the property sector. So over here, you can see that the Hong Kong's residential sale and purchase value and volume growth has been contracting and only recently recovered in the past month or so. All right, that's it from me. So I'll pass on now to Mike to talk to you about China Weekly.
Thanks, Ming. For China last week, we are seeing the May since the China PMI is the big expectations, also in the range of the expansions. Also, we are seeing the more policies will be focused on the supply side. For last week, the PBOCs are discussed the first lowering down the interest rate for the private-owned enterprise to solve the financing problems of this kind of companies. For next weeks, we are waiting for the macro numbers like the CPIs and the PMI, PPI and the consumer sectors. Also, there will be more meetings about the culture on the board. For the stock performance, we are seeing the CSI 300 down about 1.79 last week. We are continuing seeing the defensive stocks like financial stocks as continuing gaining the positive gains. We are still overweight on the finance stocks, especially for the diversified banks. Although there is the pressures for the interest margins because of the PBOCs consider lowering down interest rates for the private enterprise, but we are seeing still because of the private enterprise the rooms to follow over on the percentage on the of all the rooms is still kind of low. We are thinking there will be plenty of rooms for the room growth, and we are thinking this will offset the interest margin lowering downs. So we are continuing over maintaining the overweight for the Chinese banking sectors. This is a few the ETF that tracks the China's banking sectors, which is HIX, FXI, and the two ETFs that listed on Hong Kong. I will move on to Paul for the Singapore Weekly.
Yeah, thanks, Mike. Move on to our usual Singapore Weekly. In terms of some of the key macro numbers or key data points that came up for Singapore, we got the PMI number. It was quite it was quite an ugly number. Our PMI fell back to the lowest in 33 months, or almost 3-year lows. The other data point that came out was some of our tourist arrivals. There was a recovery in April, but I think year to date, tourist arrivals are only up 1.6. Whereas if you take a comparison to last year, it was up almost 6%. So also quite sluggish tourist numbers. In terms of the US macro, I'll show you a chart later, but in terms of the US macro, of course, the big number that came out was the jobs data, which also disappointed, likewise for the wage growth data. So what has happened is obviously the interpretation is that this will give cover for the Federal Reserve to cut rates. It's not July, it's September and December. The market is already pricing in 2 rate cut. I'll show you a chart later. But anyway, in terms of the other big data point that we got was the global macro. At least the global manufacturing PMIs are still decelerating. Okay, in terms of our tactical views, we think the policy response that we're getting, be it from the Federal Reserve or even from China, will probably just mean some sideways movement. We are still pretty negative, at least tactically. I think we're negative because there's the global slowdown. As you know, the global economy was already quite fragile even before the resumption of this so-called trade war. And we think that this global slowdown will broaden and also deepen. And it's hard to take any aggressive stance because, as you know, there's going to be a big binary event as President Trump and Xi Jinping kind of meets on 28 and 29 June in the G20 summit in Osaka. So this is a big binary event, so hard to take any aggressive positions, tactically at least. In terms of some of the stock picks, we still like some dividend yield paying stocks, especially those that we think can still grow their dividends. This will include stocks like XGX and Escort REIT. In terms of the trade deal, it's really not clear that that there's any major pressure points on Trump to make a deal. I will show you some charts. The only 2 big pressure points for him to at least nudge him for a trade deal will be the farmers. I think we'll show you later that the farm incomes, the farmers are under a lot of pressure and are suffering quite a bit. And also the next set of tariffs on China, as you know, there's another big tariff to be imposed on China. A lot of it is going to hit on the consumer goods. And as you know, US is really approaching Christmas. If they really do impose this is going to hurt the US consumers substantially. In terms of some of the key events, the 2 big events to watch will be, of course, the FOMC meeting 19, and also the even bigger one will be the G20 summit that I mentioned between Trump and Xi. Okay, anyway, just the next chart is just some charts to show you how, I mean, just to say how weak the things are. And for Singapore, you can see that the PMI numbers, the one to watch is actually for us is the new orders. New orders has quite a good correlation to the GDP. And what it shows is that it's decelerating. So if you thought first quarter GDP for Singapore was bad, I think probably second quarter will even bleaker. This is just some reflection of the visitor arrivals. This is just a global PMI. So this measures manufacturing activity. As you can see, everything is decelerating. The blue one is just a global snapshot. The rest is just US, Eurozone, and so forth. This is just to show you what the market expects from the Federal Reserve. The blue line is December 19. So the interest rates now is about 2.5. So the market now is pricing in about 2%. The federal fund rate will be around 2%. So we're looking at least two rate cuts expected by the market. Of course, it's 1.5 for December of next year. Okay, in terms of the pressure points, again, this is like guessing what's in his head. But anyway, some of the pressure points that we can at least measure somewhat is the farmers. As you know, the southern states are his big voting base. So you can see that the farmers are facing quite a tough time right now. If you look at the US loans, the amount of delinquent loans actually is rising almost back to the global financial crisis kind of levels. And also the farm incomes in red, likewise for the soybean prices, these are already trending down, and they're multiple year lows for the UF summer. So these are one pressure point that he probably has to think of if he when he has trade negotiations with China. Of course, on his approval rating, this is nationwide. Certain states, of course, is worse, but nationwide, his approval ratings isn't really collapsing. It's still holding up. So this won't be a pressure point for him. And of course, the other big pressure point, as you know, he likes to tweet on the market. So the stock market is one thing that's in his mind. At least he made, I think, 60 tweets maybe on 2018 on the market. But anyway, this is some of the red dots. So if the market doesn't collapse, I don't think there will be also another pressure point for him. Any weakness in the market will probably be the one that could actually push him, or at least nudge him to have some deal. So right now, the market holding out actually makes it a bit harder for him to nudge him to make a deal. Okay, anyway, this is my last slide at least. This is just our Phillip Absolute 10. Again, that's a refresh. This is our so-called model portfolio. We will revise it maybe every quarter. We'll make some changes. So anyway, we measure the performance every month. So for year to date, we're up probably around almost 9%. And we outperformed the STI by almost 6 percentage points. What has helped us is, of course, the yield stocks and also some of the telecommunications that have done well for us. Okay, I'll move on to Weiren.
Thank you, Paul. So right now I continue. First, we have three sectors to cover: Lockheed Martin, UOB, and Dow Jones Industrial Average. So let's look at the Lockheed Martin technical outlook. Based on the monthly LA wave count, we are now currently on the fifth wave cycle phase. And however, the completion and the confirmation of the fifth wave depends on whether price can break the resistance level at 363.47. So basically, for the weekly technical outlook, we have two scenarios in the near term. So for the scenario one, the downward broadening wedge is in fact the fourth wave corrective pattern on the money time frame that which we earlier mentioned on is the cycle wave phase. So for this scenario, we have seen the strong breakout of the wedge, and the B point is actually the strong resilience of the bullish sentiment. For this scenario one, we expect price to further strengthen itself and then to break the resistance level at 363.47. If so, then the bullish sentiment will continue to form the fifth wave at the money phase chart. However, based on scenario two, we have alternative. So there may be a possibility that this may be a premature breakout and price actually reverse at the resistance line validation level at 363. So if the price really did reverse, we expect price to correct itself to the 50% Fibonacci retracement level at near the psychological level of $300. So from there, then we will see the next movement up to break the next validation level. So let's move on to the United Overseas Bank, UOB. So UOB, currently we are in the C wave correction in action. So although the long-term trend is very bullish, we should still see that the stock will have some future upside. But however, it may reverse at $25 and fall lower to the $22 region. Okay, so should price reverse and hit $22 in the future, then we expect that price will continue to rally upon hitting $22. So let's move on. For Dow Jones, the technical outlook, we have two scenarios as well. As this shared before, Dow Jones weekly chart has expanded into a expanding triangle pattern. So currently, we are forming the D wave. However, last week we had unexpected bullish rise of the Dow Jones. So currently, for scenario one, we still expect price to continue to fall below 24,000, which is near the 61.8% of Fibonacci. and then rally thereafter. However, for scenario 2, as I mentioned last week, the bullish rise actually formed into a bullish engulfing candle at the 38.2% of Fibonacci. So should price continue to rally, it may hit beyond 27,048. And so if price do rally towards 27,048 and break the crucial resistance level to form wave D, as seen over here, then we'll see that the wave D is complete. Once the wave D is complete, then we'll see that price may have a sharp bearish correction down to 22,000. Okay, so this will end my presentation. So far, any question?
There's a question on what's the interest rate cut impact to banks. So we all know right now there's no actual interest rate cuts yet. But if there's an interest rate cut, the market is expecting it to be around September to December. So if there is an interest rate cut in September to December, that will only affect SIBOR and SOR around end December or late 2019. So any impact to the bank's result will probably only set in from 2020 onwards. So FY19 shouldn't be affected by the interest rate cuts, but more or less by the pause in interest rates.
There's a question on what's the outlook for REITs and property stocks in view of the possible Fed rates cut. So riding on what Meaning said, if traditionally the SOR has tracked the Fed fund rates, so if there's a cut following that, usually there's a cut in the SOR as well. So that's beneficial for the REITs, especially for the finance cost, which, as I talked about earlier, comprises more than 20% of their NPI. And also to note that they've already hedged, most of them have already hedged 75% of their debt on fixed interest rates. So even if there's a cut, that won't be that much of a sizable move in terms of their interest rates. Some of the REITs, I think they even have a sensitivity. If I'm not wrong, some of the Maple Tree REITs, they have a sensitivity analysis for how, if like 10 to 20 bips cut in interest rate, how that would affect their finance costs. So you can take a look at that for the REIT specific impact. In terms of the property, it's quite broad based, but I would think for SG property, for the mortgage side, if there's a cut in the mortgage, slowly, gradually there will be a follow through in terms of the healthy mortgage take up. But all things considered, we also must take into account the income as the affordability ratios, as well as the supply ratio, the property supply. And then there's a question on why is Escort REIT considered a defensive stock to hold. This, I think close to half of their income is derived from the management agreement with minimum guaranteed income. So this is regardless of any movements in the tourist arrivals or any visitor arrivals, tourism sentiment within their respective geographies that they are in. So notwithstanding any of these impact, they would still get that minimum guaranteed income level. So it's defensive in that sense. Lastly, there's a question on where to get the PMI and tourist arrival charts. We actually subscribe to CIC, so this is a paid subscription, so we get our charts from there. But I think for tourist arrivals, you can get from the STB website. They have they update this monthly. Yeah, thanks.
For there's a question for STI support resistance after G20 meeting. Currently, it's very hard to predict for what's the outcome for the G20 meeting. But however, for the intermediate support level for the STI is at 3,100 psychological level, and 3,400 is the psychological resistance level. So, but however, immediate selling zone that we are looking at is at 3,200 level. Thank you.
If there's no more questions, we will end today's webinar. Thank you.